Hey everyone, welcome back to FutureVest. If you're new here, this channel is all about building wealth and achieving financial freedom, no matter where you're starting from. Now let's face it, market volatility, those ups and downs in the stock market, can be a roller coaster of emotions. One minute you're feeling like a Wall Street wizard, and the next you're staring at your portfolio like it's speaking another language. But here's the thing, market volatility is completely normal. It's part of the game. The key is to not let those short-term fluctuations derail your long-term investment goals. So, in this video, we're diving deep into proven strategies to protect your hard-earned money during uncertain market times. And trust me, these are the exact strategies I use to navigate market swings and come out ahead. Stay tuned until the end, where I'll reveal my ultimate tip for not only safeguarding your portfolio, but actually turning market volatility into your secret weapon. Before we jump into the strategies, let's break down exactly what market volatility is and why it happens. In simple terms, market volatility refers to how much and how quickly the prices of stocks, bonds, or other investments go up and down. Think of it like a roller coaster. A smooth, gradual climb upwards is low volatility, while those sudden drops and sharp turns, that's high volatility. And just like a roller coaster, those sudden movements can be a bit unnerving, right? Now, market volatility is usually driven by a few key things. Economic uncertainty, like when interest rates are rising, geopolitical events, think trade wars or global pandemics, and even just changes in investor sentiment. Basically, how optimistic or pessimistic people are feeling about the market. For example, in 2023 alone, we saw the US stock market experience some pretty wild swings due to rising interest rates and concerns about inflation. And while those fluctuations can be unsettling, remember they also create opportunities for savvy investors. The absolute worst thing you can do during a volatile market is to panic. Seriously, when you see your portfolio dip and your gut reaction is to sell everything, that's when you're most likely to make emotional decisions that could hurt you in the long run. Remember, the market has a long history of going up over time. Sure, there will be dips and corrections along the way, but those are often temporary. By selling at the bottom of a dip, you're essentially locking in your losses and missing out on potential rebounds. Instead of panicking, take a deep breath, step back, and try to look at the bigger picture. Remember your investment goals and why you invested in the first place. Chances are, those reasons haven't changed just because the market took a dip. In fact, market downturns can actually present opportunities to buy quality investments at a discount. One of the most important things you can do to protect your investments is to understand your own risk tolerance. This means figuring out how much risk you're comfortable taking on with your money. Are you someone who can stomach big swings in your portfolio, or do you prefer a smoother ride even if it means potentially lower returns? There's no right or wrong answer here. It's all about what aligns with your personal financial goals and your ability to sleep soundly at night. Once you have a good grasp of your risk tolerance, you can start building an investment portfolio that reflects that. If you're someone who's more risk-averse, you might want to have a larger portion of your portfolio in more conservative investments like bonds. On the other hand, if you're comfortable with more risk, you might choose to allocate a larger percentage to stocks, which have historically offered higher potential returns, but also come with greater volatility. Now let's talk about one of the most powerful tools in your investment arsenal: diversification. You've probably heard the saying, don't put all your eggs in one basket, right? Well, that couldn't be more true when it comes to investing. Diversification is all about spreading your investments across different asset classes, sectors, and even geographic regions. The idea is that if one area of the market takes a hit, the other areas of your portfolio can help cushion the blow. Think of it like this. If you invest all your money in a single company, and that company goes bankrupt, you could lose everything. But if you spread your investments across, say, 20 different companies in various industries, the impact of one company's failure on your overall portfolio would be much smaller. That's the beauty of diversification. It helps reduce your overall risk without necessarily sacrificing potential returns. So, how do you actually build a diversified portfolio? Well, there are a few key asset classes to consider. First, you've got stocks, which represent ownership in publicly traded companies. Within stocks, you can further diversify by investing in different sectors like technology, healthcare, or energy. Then there are bonds, which are essentially loans you make to governments or corporations. Bonds tend to be less volatile than stocks and can provide a steady stream of income. Real estate is another asset class to consider, offering the potential for both income and appreciation. And then there are exchange-traded funds, or ETFs, which are like baskets of stocks or bonds that track a particular index or sector. By including a mix of these asset classes in your portfolio, you can create a well-diversified strategy that can help weather market storms. Let's look at a real-world example to see how diversification can protect your investments. Remember the tech sector sell-off in 2023? Tech stocks, which had been on a tear for years, suddenly took a nosedive. Investors who had all their money piled into tech stocks saw their portfolios take a significant hit. But those who had diversified their holdings into other sectors, like energy or healthcare, which performed relatively well during that time, experienced far fewer losses. That's the power of diversification in action. It helps you avoid putting all your eggs in one basket, and potentially suffering massive losses when one sector or asset class experiences a downturn. Alright, so we've talked about the importance of diversification, but I know what you're thinking. Building a diversified portfolio sounds complicated, right? Well, it doesn't have to be. There are platforms out there that make it incredibly easy, even if you're brand new to investing. One platform that I personally like is Wealthsimple. And no, this isn't sponsored, though their team is welcome to reach out anytime. What I like about Wealthsimple is that they take the guesswork out of investing. They offer these pre-built, diversified portfolios that are tailored to your risk tolerance and financial goals. They even have these cool things called TFSAs, or tax-free savings accounts, which are amazing for shielding your investments from taxes. It's like a free pass from the government to grow your money faster. And look, I know taxes might not be the most exciting topic, but trust me, keeping more of your hard-earned money is always a good thing. So, if you're looking for a way to simplify your investments and take advantage of diversification, I highly recommend checking out Wealthsimple. There's a link in my bio and no pressure, but if you do decide to sign up using my link, it helps support the channel. One of the things I appreciate about platforms like Wealthsimple is their focus on ease of use. Let's be real, nobody wants to spend hours researching individual stocks and trying to time the market. With Wealthsimple, you can set up automatic contributions and let their algorithms do the heavy lifting for you. Think about it this way, you already automate your bills, right? So why not automate your investments too? It's like setting your financial future on autopilot. You choose your portfolio, set your investment amount, and let Wealthsimple handle the rest. It's that simple. And because Wealthsimple is entirely online, you can manage your investments from anywhere, anytime. Whether you're on your lunch break or lounging on a beach, hopefully that's where you'll be someday soon, you have complete control over your portfolio right at your fingertips. Remember, investing doesn't have to be complicated. Platforms like Wealthsimple are designed to make investing accessible and stress-free. So, if you're ready to take control of your financial future, check out the link in my bio. Ultimately, the goal here is to empower you to take control of your financial future. And platforms like Wealthsimple provide the tools and resources to do just that. Remember, you don't need to be a financial expert to invest wisely. With a little bit of guidance and the right tools, anyone can navigate a volatile market and come out ahead. So, take the first step today. Explore your options, consider platforms like Wealthsimple, and start building a portfolio that aligns with your financial goals. And hey, even if you don't use Wealthsimple, the most important thing is that you're taking action. Do your research, find a platform that works for you, and start investing in your future. Because the sooner you start, the more time your money has to grow. Now, let's talk about one of my favorite strategies for navigating a volatile market, dollar cost averaging, or DCA for short. This is like having a secret weapon against those scary market dips. Instead of going all in with a huge chunk of money, you invest smaller, consistent amounts over time. Think of it like this. You're putting your money to work on autopilot, regardless of what the market is doing. This approach takes the emotion out of investing. You're not trying to time the market, which, let's be honest, is nearly impossible to do consistently. With DCA, you're buying more shares when prices are low and fewer shares when prices are high. This smooths out your average cost per share, potentially leading to better returns in the long run. And that's what we all want, right? So, whether the market is going up, down, or sideways, you're consistently investing and building your portfolio. It's like magic. but instead of pulling a rabbit out of a hat, you're pulling profits from your investments. Remember, the key to DCA is consistency. You're not trying to predict the market's next move. Instead, you're sticking to a plan, even when things get bumpy. Trust me, this disciplined approach can pay off big time. Let's look at a real-world example. Say you invested $500 every month into the S&P 500 for the past 5 years, regardless of market conditions. You would have ridden out the ups and downs, and your consistent investments would have paid off. Now compare that to someone who tried to time the market, investing a lump sum at what they thought was the perfect moment. They might have gotten lucky once or twice, but chances are, they would have missed out on some of the market's best days. And missing out on even a few of those big growth days can significantly impact your long-term returns. So, remember, slow and steady wins the race, especially when it comes to investing in a volatile market. The beauty of dollar-cost averaging is that it's easy to implement. Many brokerage accounts offer automatic investing features that make it effortless. You can set it up once and let the system do the work for you. Choose a fixed amount you're comfortable investing regularly, whether it's monthly, bi-weekly, or even weekly. Then select your investments, whether that's index funds, ETFs, or individual stocks. And that's it. You're on your way to building wealth steadily and strategically. Remember, time in the market is more important than timing the market. So start small, stay consistent, and let DCA work its magic on your investments. Now, here's the big tip, the secret sauce, the one thing you absolutely need to do to thrive in a volatile market: rebalancing your portfolio. This is essential because market swings can really mess with your asset allocation, leaving you overexposed in some areas and underexposed in others. Think of it like this. You wouldn't want your entire net worth tied up in just one stock, right? The same principle applies to your overall portfolio. You need diversification across different asset classes like stocks, bonds, real estate, and maybe even some alternative investments. And rebalancing ensures your portfolio stays aligned with your original goals and risk tolerance. Ignoring this crucial step is like setting sail without a compass. So how do you actually go about rebalancing? It's simpler than you might think. First, you need to determine your target asset allocation. This is your ideal mix of stocks, bonds, and other investments based on your financial goals, risk tolerance, and time horizon. Let's say your target allocation is 70% stocks and 30% bonds, but a market rally pushes your stocks up to 80%. In this case, you'd sell some of your stock holdings and reinvest the proceeds into bonds to bring your portfolio back to that 70-30 split. Now, this doesn't mean you need to rebalance every time the market fluctuates. It's more about periodically checking in on your portfolio, maybe quarterly or annually, and making adjustments as needed. Remember, rebalancing isn't about trying to time the market. It's about maintaining discipline and ensuring your investments stay aligned with your long-term goals. Rebalancing might seem like an extra step, but trust me, it's well worth the effort. It helps you manage risk by ensuring you're not overly exposed to any single asset class. And that's crucial in a volatile market where things can change quickly. Plus, rebalancing can actually enhance your returns over time. When you sell high and buy low, you're essentially locking in profits and taking advantage of market dips. So, make rebalancing a regular part of your investment strategy. It's like giving your portfolio a tune-up, ensuring it runs smoothly and efficiently. Remember, a well-maintained portfolio is more likely to weather market storms and deliver the returns you need to achieve your financial goals. Volatility is a fact of life in the investing world. It's like those unexpected potholes on a scenic road trip. You can't avoid them entirely, but you can certainly navigate them safely and still enjoy the journey. With the right strategies, you can protect your portfolio from those sudden market swings and even use them to your advantage. Remember dollar-cost averaging? It's like having cruise control for your investments, keeping you steady and on track. And don't forget about the importance of rebalancing your portfolio. It's the secret sauce to maintaining the right mix of investments and managing risk. Which of these tips will you apply to your investments? Let me know in the comments. Don't forget to like, subscribe, and hit the bell for more FutureVest insights. Remember, a disciplined investor is a successful investor.